In this video, traders, we're going to look at 5 reasons the 5-period simple moving average is more useful than you think. Stay tuned. Hey guys, warm welcome to you. Alright, so 5 reasons why the 5-period SMA is more useful than you think. Many people write off the 5 SMA, they think, you know what, it's 5-period, how useful can it be? It's so tight to price, it kind of runs with price. You know, everyone kind of goes to the 10, the 20, the 50, 100, 200, those are the big ones. And you can see why. Your 20 period's a nice level for a pullback. When you have that first kind of pullback, 100 period gives the swing traders the filter they're looking for. 100 and 200, those cross generally means they want to stay bullish or bearish. And you can understand those. And the 5 kind of looks like it's just a noisy thing that's just shadowing price. And in some instances it is, because obviously the lower the number on the moving average, the more likely it's going to just follow price directly, because it's only smoothed by 5 periods. It's a 5-period moving average, of course, so it's the average of the last 5 periods of price. So you can see why some people will write it off completely. However, I've got 5 ways or 5 reasons why it's more useful than you think. The first one is this, guys. It's a good way to trail a stop. I don't know about you, have you been in a trade? And by the way, this is a daily chart. You could probably mess around with it on a 4-hour or an hourly. Start getting below than that. Okay, saying that, I was about to kind of, I've stopped myself before I wanted to say it then. For some of these it works, and let's say which ones it does as we go through it. So this would work on many time frames. So some of these are just on the daily, but this would work on many time frames, trading the stop. So what I mean by this, so you're in a trade, it's pushing long, you think, wow, this thing's really stretched, I want to take profits. Hold up. Wait, because you can often be in a trade that is just running and running and running and running. It's very difficult to know when it's going to be that stretch one. Then as a trader, we can feel the stretch. Like, man, this thing's stretched. It's going to pull back, it's going to pull back. Super stretched, and you know it is at some point. But this is when the 5 SMA comes in nicely, is that you hold it until you break that 5, or you get a close below, should I say, the 5-period SMA. Because very often, guys, especially on a swing trade, you might get 4 or 5 days more where it just goes rips and rips and rips, and you'd have been out on it on day 2 because you think it's really frothy, really toppy, you got a good profit, and saying, you know what, I will have a close if, I will have a stop if, or I'll close the position, should I say, if we close under that 5-period SMA. And that's the same also for a day trade. How many times have you been in a day trade where, let's say you're watching the 5-minute chart, right? And you're in a trade, bang, it rips up, you're like, yeah, that's a good profit. But then it rips up and keeps going, keeps going, keeps going, and you're out of the position. This helps you stay in the position for a volatility expansion runner. Trail it up that 5 period. Yes, it's tight, appreciate that, but that's why it's so good in these circumstances. Because if it suddenly gets to close below, you're out, you've not given much back. But if it just keeps going and going and going and going, travels really far on a long sprinting run, eventually when it does pull back, you might end up with 100 pips in the pocket. Really useful way of doing it. So it's a good way to try to stop, guys. That's one of the most key things for a 5-period moving average. And that looks more like a trend line actually, doesn't it? Obviously, you know, it will look more curved and it will kind of follow the route of price as opposed to being a trend line. But very often it does. If a market is like ripping up like that, it will almost look like a trend line because it'll be very, very linear. Obviously it goes on the close as well. And you can decide to do it on the close, you can do it on the average of the open, high, low, close. You can play around with things like that, but close is pretty standard. And you often find how straight it can get, because literally if the price is ripping and it's constantly closing at highs, closing at highs, closing at highs, all you're doing is getting that equal move up. Anyways, by the by. Number 2, it signifies extreme trend. So yeah, well, yeah, so what? But what does it mean? Okay, so it signifies extreme trend. So that means that we can say, hey, you know what? If we've got an extreme trend, when we get a first kind of counter trend move, we can probably buy it in the case of an uptrend, because the likelihood is it's so extreme, people are so caught offside, it's so aggressive, the supply demand balance has shifted so much, one small movement, 1 or 2 day moves away from it could probably be a good place to buy, looking for a continuation. And you can use this, like how many closes above the 5-period SMA. I know Linda Bradford Rashke has done some really great studying on that, so I'm not going to go into that. Go and check it out if you want to find out more information from the person who's actually done it. But multiple closes above a 5-period SMA normally results in a trading opportunity when you get some kind of retracement back underneath it. So even if you're not using that per se, you could say, right, right, well, how many closes are we getting above? How many times has the price been above the 5 period SMA over this period? There's loads of ways you can mix it and match it to gauge strength, and then use that as something to say, hey, this market's exhibiting strength, this stock's exhibiting strength. You might want to look at buying a bull flag or a little pullback or something like that. So it's a very good way of filtering out extreme trend as opposed to a 20 period, which is more rotational, bouncing off it, etc. So extreme trend, or supply, I've got another way of putting it, is extreme supply-demand imbalance. All right, number 3, price distance away from it can be used as a mean reversion tool. So when you really stretch away from that 5 period SMA, if you're assuming, like let's stay here, you get like a trade right up here, you've already been several closes above, you've already been kind of hugging that 5 period SMA, then you get a real extension up. That might be the exhaustion candle you're looking for a counter trend play on the second day coming back. And I know you've got to be careful with these trends, but this is the kind of thing, because it's so tight to price and it's going on the last 5 days worth of trade. If it really starts extending away from it, so distance of the price from the 5 period SMA, you might want to look at it as a short-term mean reversion scalp type trade. Number 4, it smooths out price, but not too much. So it's quite nice to look at it and see it visually. I sometimes like to have it as a thicker line because it does smooth out price. So you can see, well, obviously, but it smooths out price, but not too much. In other words, you can still see the ebbs and flows and the ranges and the patterns, but without it ignoring some of the more useful breakouts. You know, with like a 20 period, you might get a breakout for one day that's quite significant, but it wouldn't show up on the 20 period. A 5, a recent breakout one day, maybe not, but maybe 1 or 2 days above a certain level, that will start to show as a spike in the 5. So it's quite handy to see the smoothed out version of price, but without ruining too much of the information. Number 5, guys, you can use it as a crossover filter. So one way you can use it is you can just use the 5 period SMA and say, hey, listen, if that's crossing through the 20 or through another a 50 or even a 10, maybe a bit tight, but you can play around with different settings and say, hey, well, if while the 5 period SMA is below the 20, I want to stay short, or while the 5 period is above, I want to stay long, or flip it on its head and say, hey, we're in an uptrend on the daily, right? So while the 5 period SMA on the 15, for example, is under the 20, I'm going to look for bottoming patterns, because I believe that that will be a pullback on a daily that's going to look for a further push up and break out of highs maybe several weeks later. So you can use go down the time frames and use that as a kind of filter and say, right, well, now we're in lower territory on the 15, 5's below the 20, we're still kind of broadly an uptrend on the daily. Now I look for my bottoming pattern, double bottom, some kind of fake out, whatever it may, bullish engulfing, whatever floats your boat for that. So it's quite a nice filter if you like to use it in that way. So there you go. That's 5 ways or 5 reasons the 5 SMA is more useful than you think. Take care. Keep your risk managed, whatever you're doing. I'll see you in the next one. Bye-bye.